Next guest still sees Netflix as a buy, and he's got a $725 a share price target on it. That's up $175 from here. That's the highest on the street, implying a 30% rally. He's John Blackledge. He's the internet analyst at TD Cowen. John, welcome. Good to have you with us.
Thanks for having me. Appreciate it.
So let's bear down on what seems to have the market worried today, and that is the cessation of providing net new subscribers and average revenue per user going forward starting next year. Is that as big a deal as the market seems to be making it?
I don't think so, Tyler. They're going to pull the member number and the average revenue per member metrics next year, but they did tell us they're going to give full year guide range, and they actually gave it for 2024 last night. And I just don't think it's a big deal. They told us they're going to talk about what drives revenue quarter in, quarter out. And they're also going to periodically give, kind of member milestone updates. Mm-hmm. So I think it'll be fine. And the other thing that I think people forget, I've covered Netflix for about 15 years, but in 2012, they eliminated some metrics. They eliminated churn, gross member adds, and at the time it was kind of a big deal, but then it wasn't. And so I think it'll be kind of something similar. And the company also explained, like, they introduced an ad tier. They have various different price points across all different kinds of geographies or regions. So we're what we're saying today is it's not that big of a deal. It was a really good start to the year. We remain bullish near and longer term, and think it's a good opportunity for investors that were on the sidelines to maybe get involved.
So let me squeeze in one more on this change and what they're going to report. I guess there could be sort of two explanations here. On the one hand, they could be ceasing to give these net adds and revenue per customer numbers because those numbers are less relevant today than they used to be. On the other hand, they could be doing it because they're worried that the numbers are not going to be as favorable as they have been. Which is it in your view?
The former. They're relevant. They're a little less relevant. I mean, I think what they've told us, right, is they're going to grow revenue 13 to 15% this year, and then they expect to grow revenue double digits in the coming years, and that's a function of member growth and average revenue per member growth, as well as kind of their ramping advertising business. So there's just more things going into driving revenue now, and it's not as clear cut than kind of looking at the member and the revenue per member, and so that's why they're kind of pulling it.
Their numbers on the trailing quarter were really, really good, and included adds of subscribers. It included an EPS beat, a revenue beat, and so on and so forth. So it was really good. The only weak spot, I guess, was a little squishy, was second quarter revenue forecast, right?
Yeah, the 2Q revenue was light, but there's also, kind of some FX headwinds there. So, that was, I think folks should look past that. And the other thing I would call out is, kind of they gave 13 to 15% top line guide for 2024. That includes some FX headwinds. We have about 16%. We're expecting about 16% top line growth for 2024. So we're a bit above the high end of their guide.
I guess one thing that sort of stands out to me in this area is that the streaming world feels increasingly saturated, I guess is the word I would use. There are a lot of players here, but Netflix is the king of the realm, isn't it?
By far, yeah. They're the global leader. With what the 270-ish million subs are going to spend $17 billion on content this year. And one thing that I thought was interesting.
Is the field saturated, though? I guess would be maybe the better question here. If it is saturated, I'd sure prefer to be Netflix on top of a saturated field than several of the others that are not as strong. Is the field saturated?
Well, there are obviously a number of different streaming platforms, but yeah, like Netflix is the global leader. We expect them to continue to be the global leader. They've been the most innovative company in this space. And obviously, like I was saying, $17 billion in content spend this year. They continue to improve the service. So yeah, and on a global basis, I mean, you have to look at them and Prime Video, Disney Plus, but yeah, for us, Netflix we think will remain the kind of global streaming leader.
John, thank you so much for your time today. We appreciate it.